IBM, let's do IBM because it's going to be a slow grower. 110 billion, PE 14.
That's
check
nice.
mark.
I like that.
Yep. Profit margin a little bit below where we want it. Although I will say this, in the last 12 months, it's up over 10%. So I'm going to give it a check mark.
Pillar number 3, revenue growth, baby.
All right, ready? 81.7 down to 77. X. Guys, look at their revenue. It's down a lot in the last 20 years, in the last 10 years.
Profit growth, as I'm assuming, is not doing well either.
Let's find out. So profit has gone from 13.2 down to 9.4. X as well. Now remember, guys.
Pillar number 5, which is number of shares outstanding. We want that going down.
Check mark, 978. So a little under $1 billion to 887. 40 billion in current assets, 38 billion in current liabilities. So barely a check mark, but it's still there. They got a lot of debt.
Free cash flow growth.
Are you ready? 13.1, 12.9, 13, 11.3, 11.8. So X again, the average.
12.4. 12.4.
I'm gonna pay 10 times that. This is a losing company. Actually, probably even less than that. I probably wanna pay 8, I don't know, I probably wanna pay 8 times that. So call it $100 billion. It's currently at 113 billion. It's pretty close. Guys, the reason I'm doing such a small amount, you gotta really make your money because everything shows this company is losing revenue and profit. So if you have to assume that keeps going, if there's not a story that you can sit there and see how it gets better, then you gotta do that. Let's see their acquisitions. They spent 31 billion acquisitions. Yeah, they spent a lot of money in acquisitions, guys. What did they buy in freaking 2020? Let's see how they're doing in revenue the last 12 months. Trailing 12 months revenue. It's still down from last year. Jesus Christ. How about their profit? Their profit is down also. Yeah, this is tough, guys. So this is where it is. When you see a company losing this much revenue, this much profit, you got to pay as little as possible. I mean, maybe 113 billion is too much. Maybe 100 billion is too much. Maybe you need to be at 80 billion. I don't know. But the good news is, if you like their free cash flow, they need to spend a lot of their money on the free cash flow to buy dividends back. You know, I actually want to avoid IBM, I think. Because look how much debt they have. They have $130 billion in debt, and their revenue is going down, their profit's going down. That's not a good scenario. How do you retire your debt with your revenue and profit going down like that? I'm actually going to say avoid IBM.